What is the concept of time value of money, TVM? The time value of money, TVM, is the idea that money available today is more valuable than the same amount of money in the future. How can the TVM concept be applied in financial decisions? TVM is used to calculate the present and future values of money, helping to evaluate the profitability and worth of investments and financial transactions. Define discounting in the context of TVM. Discounting is the process of determining the current value of future cash flows using a discount rate. What is the discount rate, and why is it crucial in TVM calculations? The discount rate is the interest rate used to calculate the present value of future cash flows. It is essential because it reflects the opportunity cost of investing money elsewhere. How can the duration of an investment or loan impact TVM calculations? The duration represents the length of time for which an investment or loan is held. It affects the total return or cost of the transaction when considering the time value of money. How is the payment, cash flow, relevant in TVM calculations? The payment refers to the cash inflow or outflow at a specific time. It is essential in TVM calculations, as it determines the amount and timing of cash flows affecting present and future values. Explain the concept of future value, FV, in TVM. Future value, FV, is the value of an investment or cash flow at a specific time in the future, considering its compounding or discounting. What does interest rate mean, and how is it related to TVM? The interest rate is the cost of borrowing money or the return on investment. It plays a crucial role in TVM calculations as the discount rate or compound interest rate. In what major financial decision-making process is discounting frequently used? Discounting is extensively used in capital budgeting, which involves evaluating long-term investments and expenditures. Why should a business consider the total value of an investment, not just its present worth? To make informed financial decisions, businesses need to understand the complete value of an investment, including future cash flows. How can TVM help in comparing two investment options with different payment timelines? TVM allows for an apples-to-apples comparison by discounting future cash flows to their present value, enabling an objective evaluation of investment options. How does TVM theory justify the discounted value of option 2 in the lottery example? TVM theory states that future cash flows are worth less than the same amount received today, so option 2's payments need to be discounted to compare its present value with option 1. Why is understanding the cost of not having access to money crucial in evaluating investment options? The cost of not having access to money, known as the opportunity cost, affects the present and future values of investment choices. How can one calculate the future value, FV, of an investment using the compound interest formula? FV equals PV asterisk 1 plus I caret T, where FV is the future value, PV is the present value, I is the interest rate, and T is the time period. What is the key advantage of Bank 2's interest rate over Bank 1's in the savings account example? Bank 2 offers a higher interest rate, resulting in a higher future value for the deposited amount. How does a higher interest rate impact the future value of money in the savings account example? A higher interest rate increases the future value because the deposited money grows faster over time. What does the term compound interest mean in the context of the savings account example? Compound interest refers to the interest earned on both the initial deposit and the previously accumulated interest. How can TVM principles be applied in personal financial decisions, apart from business contexts? TVM can be used in personal financial planning, such as comparing different mortgage or loan options or assessing retirement savings plans. Explain how TVM plays a role in evaluating the profitability of a business project. TVM helps determine whether a business project's future cash flows will provide a satisfactory return on investment by discounting them to their present value. How does TVM assist individuals in making prudent investment choices? TVM allows individuals to assess the true worth of investment opportunities by considering the time value of their money. When would you use the concept of TVM in everyday financial situations? TVM can be used in various everyday financial scenarios, such as deciding between leasing and buying a car or evaluating the best credit card offers. Define opportunity cost and its relevance in TVM calculations. Opportunity cost is the cost of foregoing the next best alternative when making a financial decision. It is crucial in TVM as it affects the discount rate used in calculations. How can a lower discount rate impact the present value of future cash flows? A lower discount rate leads to a higher present value of future cash flows since the cost of waiting for cash diminishes. Why is TVM particularly important in long-term investments and retirement planning? In long-term investments and retirement planning, the impact of time on the value of money becomes more significant, making TVM principles essential for decision-making. Describe the role of TVM in assessing the profitability of a loan. TVM helps borrowers determine the actual cost of a loan by discounting the future payments to their present value, aiding in assessing affordability and alternatives. How can the concept of TVM be applied in evaluating insurance policies? TVM can be used to determine the present value of insurance premiums and potential future benefits, aiding individuals in choosing the most suitable policy. What factors can influence the choice of an appropriate discount rate in TVM calculations? The choice of discount rate can be influenced by factors such as inflation, risk, and alternative investment opportunities. How is TVM used to evaluate the profitability of a real estate investment? TVM is used to discount the expected future cash flows from a real estate investment to their present value, enabling an assessment of its profitability. Explain the relationship between interest rates and the cost of borrowing in TVM. Higher interest rates result in higher borrowing costs, reducing the present value of future cash flows related to loans. What are the potential limitations of using TVM in financial decision-making? TVM calculations assume that future cash flows are predictable and certain, which may not always be the case, leading to some limitations in decision-making. Can TVM be applied to analyze non-monetary benefits or costs? Yes, TVM principles can be applied to analyze non-monetary benefits or costs by assigning monetary equivalents. Describe the process of calculating the present value, PV, of an investment with multiple cash flows. To calculate PV with multiple cash flows, discount each cash flow individually to the present and then sum the present values. How does TVM influence the determination of an appropriate retirement savings amount? TVM helps individuals calculate the necessary retirement savings amount by considering future expenses and discounting them to their present value. What are the implications of using TVM in pricing financial instruments such as bonds? TVM is fundamental in pricing bonds, as it determines their present value based on future cash flows, coupon payments and principal, and the prevailing interest rates. In what ways can TVM assist in evaluating the profitability of a business expansion project? TVM allows businesses to assess the expected cash flows from an expansion project and discount them to their present value, helping in decision-making. How can inflation impact TVM calculations and financial decision-making? Inflation can erode the purchasing power of money over time, necessitating adjustments to discount rates and future cash flows in TVM calculations. Describe the relationship between risk and the discount rate in TVM. Higher risk in an investment or transaction typically leads to a higher discount rate, as investors demand a higher return to compensate for the risk. How can TVM be utilized to assess the affordability of major purchases, like a house or a car? TVM can be used to determine whether the cash flows associated with purchasing a house or a car are manageable and affordable in the long run. What happens to the future value, FV, when the compounding frequency increases? When the compounding frequency increases, the future value grows faster, resulting in a higher return on investment. How does TVM apply to evaluating the returns on different investment portfolios? TVM helps in comparing the returns of different investment portfolios by discounting future cash flows to their present value and assessing the risk-adjusted returns. Can TVM be used to analyze the potential returns from starting a business venture? Yes, TVM can be applied to evaluate the profitability of a business venture by considering projected cash flows and discounting them to the present value. How can TVM assist in making informed decisions about refinancing existing loans? TVM allows individuals or businesses to evaluate the savings gained from refinancing by discounting the future cash flows of the new loan to their present value. What is the significance of TVM in determining the fair value of company shares? TVM helps analysts determine the fair value of company shares by assessing the present value of future cash flows expected from the company's operations. Explain the role of TVM in assessing the cost-effectiveness of different payment options for large purchases. TVM can be used to compare the present value of various payment options, cash, credit, or installment plans, for large purchases like electronics or furniture. How can TVM principles be applied in evaluating the profitability of renewable energy projects? TVM allows for the assessment of renewable energy projects by considering the long-term cash flows and discounting them to their present value. Describe a scenario where a low-interest rate environment impacts TVM calculations. In a low-interest rate environment, future cash flows are less discounted, leading to higher present values for investments and lower borrowing costs. Can TVM be used to analyze the financial viability of leasing versus purchasing equipment for a business? Yes, TVM can be applied to compare the total costs of leasing and purchasing equipment by discounting future cash flows related to each option to their present value. What are the potential drawbacks of relying solely on TVM in making financial decisions? Relying solely on TVM may overlook qualitative factors, risk assessments, and external economic influences, leading to incomplete decision-making. How does TVM assist in determining the optimal duration for holding an investment? TVM helps in determining the optimal holding period by comparing the present value of cash flows for different investment durations. In what ways can TVM be applied in evaluating the returns on investment in education? TVM can be used to assess the returns on investment in education by comparing the present value of future career earnings to the cost of education. Explain how TVM calculations can be used in retirement planning to ensure a comfortable lifestyle. TVM allows individuals to estimate the required retirement savings by discounting future expenses and income to their present value. Can TVM be utilized in determining the affordability of long-term healthcare insurance? Yes, TVM can be used to evaluate the affordability of long-term healthcare insurance by discounting future premiums and benefits to their present value. How does TVM apply to evaluating the profitability of energy-efficient home upgrades? TVM can be used to assess the cost-effectiveness of energy-efficient upgrades by discounting future energy savings to their present value. What is the primary difference between simple interest and compound interest in TVM calculations? In simple interest, only the initial principal earns interest, while in compound interest, interest is reinvested and added to the principal, leading to exponential growth. How can TVM be applied to assess the cost-effectiveness of subscribing to renewable energy sources for homes? TVM can be used to compare the present value of future energy costs for subscribing to renewable energy sources with the present value of standard energy costs. Explain the concept of annuities in the context of TVM calculations. Annuities refer to a series of equal periodic payments or receipts over a specified time period, which can be evaluated using TVM principles. How does TVM influence the determination of an optimal repayment schedule for a loan? TVM helps borrowers identify the most cost-effective loan repayment schedule by discounting future payments to their present value. Describe how TVM can assist in making better investment decisions during economic downturns. TVM can be used to evaluate investment opportunities during economic downturns by assessing their long-term profitability and risk. Can TVM be applied in the evaluation of government projects and infrastructure investments? Yes, TVM can be used to assess the financial viability of government projects and infrastructure investments by discounting future cash flows to their present value. How does TVM play a role in analyzing the potential returns from investing in the stock market? TVM can be used to assess the potential returns from investing in the stock market by discounting future dividends and capital gains to their present value. Explain how TVM principles can aid in determining the best time to start a retirement savings plan. TVM allows individuals to identify the optimal time to start a retirement savings plan by considering the impact of early contributions on future wealth. How can TVM assist in analyzing the potential returns from investing in cryptocurrencies? TVM can be applied to assess the potential returns from investing in cryptocurrencies by discounting future projected values to their present value. Describe a scenario where TVM calculations may not provide accurate results. TVM calculations may not be accurate when future cash flows are uncertain or subject to significant volatility. How does TVM affect the determination of the most profitable option in lease versus buy decisions for equipment? TVM allows businesses to compare the present value of costs associated with leasing and buying equipment, helping in making the most profitable choice. Can TVM be applied in analyzing the financial impact of environmental sustainability initiatives for businesses? Yes, TVM can be used to assess the financial impact of sustainability initiatives by discounting future cost savings and benefits to their present value. Explain how TVM can be used in evaluating the profitability of investments in research and development projects. TVM helps in evaluating the profitability of research and development projects by discounting expected future revenues and costs to their present value. How can TVM assist in making informed decisions about refinancing existing mortgages? TVM enables borrowers to assess the savings gained from mortgage refinancing by discounting future mortgage payments to their present value. Describe the importance of considering the rate of inflation in TVM calculations. Considering the rate of inflation is crucial in TVM calculations as it affects the purchasing power of future cash flows and the appropriate discount rate. How can TVM be utilized to evaluate the profitability of investing in renewable energy technologies for businesses? TVM allows businesses to assess the profitability of investing in renewable energy technologies by discounting future cost savings and benefits to their present value. In what ways can TVM be applied in evaluating the returns on investment in employee training and development programs? TVM can be used to assess the returns on investment in employee training and development programs by comparing the present value of future benefits with the program's cost. Explain how TVM principles can help in determining the optimal duration for holding stocks in a portfolio. TVM helps investors determine the optimal duration for holding stocks by considering the present value of dividends and capital gains at different time horizons. Can TVM be used to evaluate the financial viability of sustainability projects for nonprofit organizations? Yes, TVM can be applied to assess the financial viability of sustainability projects for nonprofit organizations by discounting future cost savings and benefits to their present value. Describe the relationship between TVM and the concept of compounding in investment scenarios. TVM is closely related to the concept of compounding, as both involve calculating future values based on interest rates and time periods. How does TVM assist in determining the most suitable savings plan for achieving a specific financial goal? TVM allows individuals to compare different savings plans by discounting future contributions and interest earnings to their present value, aiding in identifying the most suitable option. What is the time value of money? The time value of money is the concept that money is worth more today than it is in the future. Why is receiving $100 today better than receiving $100 in the future? Receiving $100 today is better because you don't have to wait to use the money and can invest or spend it immediately. Define present value, PV, and future value, FV, in the context of the time value of money. Present value, PV, is the value of money today, while future value, FV, is the value of money in the future after a certain time period. What is the interest rate, I, in the context of the time value of money, and how is it related to the change in the value of money after 1 year? The interest rate, I, is the rate at which the value of money changes after 1 year. For example, if money today is worth 10% more in 1 year, the interest rate is 10%. How does the time value of money concept impact financial decision-making, such as investments and borrowing? The time value of money impacts financial decisions by considering the value of money over time, influencing investment choices and borrowing terms. Define simple interest and how it differs from compound interest. Simple interest is when interest is only calculated on the original principal amount, while compound interest includes interest on previously earned interest. How is the time value of money concept relevant in personal financial planning, such as saving for retirement? The time value of money is crucial in personal financial planning as it helps individuals understand the impact of inflation and interest rates on their savings over time. How can the time value of money be used to compare different investment opportunities? The time value of money can be used to calculate the future worth of different investment opportunities and compare their potential returns. Discuss the importance of the time value of money in loan repayment schedules. The time value of money is important in loan repayment schedules as it helps determine the total amount repaid, including interest, over the loan term. How does the time value of money concept apply to the pricing of financial assets, such as bonds and stocks? The time value of money influences the pricing of financial assets by considering future cash flows and discounting them to their present value. Define the concept of discounting in the context of the time value of money. Discounting is the process of calculating the present value of future cash flows by applying the appropriate interest rate. Explain the term opportunity cost and how it relates to the time value of money. Opportunity cost refers to the cost of foregoing the next best alternative when making a decision, and it is related to the time value of money by considering the value of money over time. How does inflation impact the time value of money? Inflation erodes the purchasing power of money over time, reducing the value of future cash flows and affecting the time value of money. Describe an example of a scenario where the time value of money plays a significant role in financial decision-making. An example scenario is deciding whether to invest in a long-term project with future returns or to invest in a short-term project with immediate returns, considering the time value of money. What are the potential limitations or assumptions of the time value of money concept? The time value of money concept assumes a constant interest rate and does not account for unpredictable events that can impact financial outcomes. How can individuals apply the time value of money concept to make informed decisions about saving and spending? Individuals can use the time value of money to understand the impact of saving early and investing wisely on their long-term financial goals. Discuss the relevance of the time value of money in the context of financial planning for major life events, such as buying a house or funding education. The time value of money is relevant in financial planning for major life events as it helps individuals prepare financially by considering future expenses and investments. What role does compounding play in the time value of money, and how does it affect investment returns? Compounding refers to the process of earning interest on both the principal amount and previously earned interest, leading to exponential growth in investment returns over time. How can businesses use the time value of money concept to assess the profitability of long-term projects? Businesses can use the time value of money to calculate the net present value, NPV, of long-term projects and determine their profitability. Explain the concept of a discount rate and its significance in discounting future cash flows. The discount rate is the interest rate used to calculate the present value of future cash flows, representing the required rate of return for investors. How do changes in interest rates impact the time value of money, and what are the implications for borrowers and savers? Changes in interest rates can affect the time value of money by altering the present and future values of cash flows, influencing borrowing costs and investment returns. Discuss the relationship between the time value of money and the risk associated with investment decisions. The time value of money is related to investment risk, as it considers the value of money over time and the uncertainty of future cash flows. What are the potential benefits of considering the time value of money in financial decision-making? Considering the time value of money helps individuals and businesses make informed decisions, optimize investments, and achieve long-term financial goals. How can individuals use the time value of money concept to plan for retirement effectively? Individuals can use the time value of money to estimate their future financial needs for retirement and determine the appropriate savings and investment strategies. Discuss the impact of the time value of money on the concept of risk and return in investment analysis. The time value of money influences risk and return analysis by considering the timing of cash flows and the impact of interest rates on investment outcomes. How can the time value of money concept be applied in the evaluation of business expansion opportunities? Businesses can use the time value of money to evaluate expansion opportunities by comparing the present value of costs and benefits over time. Explain the concept of annuities and how the time value of money is relevant in annuity calculations. Annuities are a series of equal periodic payments, and the time value of money is relevant in calculating the present value or future value of annuity payments. How does the time value of money impact decision-making when choosing between different loan options with varying interest rates and terms? The time value of money affects decision-making by helping borrowers compare the total cost of different loan options and choose the most favorable terms. What is the relationship between the time value of money and the concept of risk aversion in investment decisions? The time value of money is related to risk aversion as it considers the certainty or uncertainty of future cash flows and how it affects investment choices. How does the time value of money concept apply to inflation-adjusted investments, such as Treasury inflation-protected securities, TIPS? The time value of money is relevant in inflation-adjusted investments as it helps investors assess the real returns after considering inflation. How does the time value of money concept impact decision-making in the context of paying off debts or loans early? The time value of money influences the decision to pay off debts early by comparing the interest savings versus other potential investment opportunities. What factors can affect the interest rate used in time value of money calculations? Factors such as inflation rates, risk premiums, and central bank policies can impact the interest rate used in time value of money calculations. How does the time value of money concept apply to retirement savings and the importance of starting early to save for retirement? The time value of money emphasizes the benefits of starting early to save for retirement, as it allows more time for investments to grow and compound. Explain the significance of the time value of money in capital budgeting decisions. The time value of money is crucial in capital budgeting decisions as it helps businesses assess the profitability and feasibility of long-term projects. Discuss the role of risk and uncertainty in time value of money calculations. Risk and uncertainty in investment outcomes can affect the discount rate used in time value of money calculations, influencing the present value of cash flows. How can individuals use the time value of money concept to assess the impact of inflation on their purchasing power? Individuals can use the time value of money to calculate the real value of future cash flows after accounting for inflation. How does the time value of money concept apply to leasing versus buying a durable asset, such as a car? The time value of money is relevant in comparing the cost of leasing versus buying a durable asset over time, considering the present and future values of cash flows. How can businesses use the time value of money concept in budgeting and financial planning? Businesses can use the time value of money to plan for future expenses, evaluate investment projects, and optimize cash flow management. How does the time value of money concept apply to the calculation of the internal rate of return, IRR? The time value of money is essential in calculating the internal rate of return, IRR, which determines the rate at which a project breaks even. How does the time value of money concept apply to bond pricing and yield calculations? The time value of money is relevant in bond pricing by considering the present value of future coupon payments and the final principal payment. Explain the concept of perpetuity and how it is related to the time value of money. Perpetuity is a financial instrument that provides a stream of cash flows indefinitely, and it is related to the time value of money by considering the value of cash flows over an infinite time horizon. How can the time value of money concept be applied to calculate the cost of delaying retirement savings? The time value of money can be used to estimate the additional savings required if retirement contributions are delayed, considering the impact of compounding over time. How does the time value of money concept apply to rental property investments and cash flow projections? The time value of money is relevant in rental property investments by considering the present value of rental income and future property values. Explain the concept of the present value of an annuity and how it is calculated using the time value of money principles. The present value of an annuity is calculated by discounting the future annuity payments to their equivalent value at the present time. Discuss the role of compounding in retirement savings and how it affects the overall growth of investments. Compounding plays a significant role in retirement savings as it allows investments to grow exponentially over time, maximizing retirement funds. Explain the term discount factor and its use in calculating the present value of future cash flows. The discount factor is used to convert future cash flows into their equivalent present value by accounting for the time value of money. How can individuals use the time value of money concept to prioritize financial goals? Individuals can use the time value of money to assess the impact of different financial goals over time and prioritize them accordingly. How does the time value of money concept apply to tax planning and the timing of income and expenses? The time value of money is relevant in tax planning by considering the timing of income and expenses to optimize tax liabilities. How does the time value of money concept apply to calculating the return on investment for different asset classes? The time value of money is used to calculate the return on investment by considering the present and future values of cash flows from various assets. How can businesses use the time value of money concept to evaluate the profitability of leasing versus buying equipment? Businesses can use the time value of money to compare the present value of costs and benefits of leasing and buying equipment over their useful life. How can the time value of money concept be used to set financial goals and create realistic timelines for achieving them? The time value of money can help individuals set realistic financial goals by understanding the impact of time on saving and investment returns. How does the time value of money concept apply to personal financial decision-making, such as saving for emergencies? The time value of money is relevant in personal financial decisions by considering the impact of time on emergency savings and investment returns. How can the time value of money concept be used to determine the optimal loan term for mortgage borrowers? The time value of money can help mortgage borrowers evaluate the total cost of different loan terms and choose the most suitable option. How does the time value of money concept apply to evaluating the effectiveness of marketing campaigns with long-term impact? The time value of money can be used to assess the long-term return on investment of marketing campaigns by considering future revenue and customer retention. Discuss the potential ethical considerations related to the use of the time value of money concept in financial decision-making. Ethical considerations may arise when using the time value of money, such as ensuring transparency and fairness in financial planning and investment advice. How can individuals use the time value of money concept to make informed decisions about retirement savings and investment strategies? Individuals can use the time value of money to estimate their future financial needs for retirement, set savings goals, and develop appropriate investment strategies. What are the 5 components of time value of money, TVM, used in financial calculations? The 5 components of TVM are discount rate, duration, number of periods, payment, present value, PV, and future value, FV. Define single period investment. A single period investment is an investment that takes place over one period, typically 1 year. What is the formula for calculating the future value, FV, in a single period investment? The formula for calculating the future value in a single period investment is FV equals PV, 1 plus I. When is a multi-period investment considered to have taken place? A multi-period investment is considered to have taken place when the investment spans more than one period, usually more than 1 year. What are the key terms used in time value of money calculations? The key terms used in time value of money calculations are multi-period investment, periods to earn in, and single-period investment. If the number of periods to earn in is 1 in a single-period investment, what is the relationship between future value, FV, and present value, PV? In a single-period investment, FV equals PV, 1 plus I, where I is the interest rate. How many variables do you need to know in a single-period investment, and which ones are they? In a single-period investment, you only need to know 2 of the 3 variables PV, FV, and I. What is the difference between compound interest and simple interest formulas in multi-period investments? Compound interest uses the formula FV equals PV, 1 plus IT, while simple interest uses the formula FV equals PV, 1 plus ERT. In a single-period investment, which formula is used when the number of periods T is equal to 1? When T equals 1 in a single-period investment, both compound interest and simple interest formulas become FV equals PV, 1 plus I. Explain the concept of periods in time value of money calculations. A period refers to a general block of time, usually 1 year, used in time value of money calculations. How can the TIBA2 Plus calculator help calculate the future value, FV, in a single period investment? The TIBA2 Plus calculator can be used by inputting the relevant time value of money, TVM, values such as N, I/Y, PV, PMT, and then using CPT FV to find the future value. Define the discount rate in time value of money calculations. The discount rate refers to the interest rate used to convert future cash flows into present value. Explain the importance of knowing the duration, number of periods, in time value of money calculations. Knowing the duration is crucial as it indicates the number of periods over which an investment will grow or the debt will be repaid, affecting the future and present values. Explain the difference between a single-period investment and a multi-period investment. A single-period investment takes place over one period, usually 1 year, whereas a multi-period investment spans more than one period, typically multiple years. Why is the concept of time value of money important in financial decision-making? Time value of money helps in understanding the worth of money over time, influencing investment decisions and financial planning. How does the number of periods affect the future value and present value in time value of money calculations? The number of periods, 2 or N, affects how much an investment grows, future value. The debt reduces, present value, over time. Explain the concept of payment in time value of money calculations. Payment refers to any cash flows that occur at regular intervals, such as annuities or loan payments, which can affect future and present values. Why is understanding the relationship between present value, PV, and future value, FV, crucial in financial planning? Understanding the relationship between PV and FV helps in making informed investment decisions and determining the profitability of investments. Explain how the interest rate, I, affects the future value, FV, and present value, PV, in time value of money calculations. The interest rate directly impacts the growth of future value and the discounting of present value over time. Define annuity and explain its significance in time value of money calculations. An annuity is a series of equal cash flows received or paid at regular intervals. It is significant in time value of money calculations as it affects the future and present values. How does the duration, number of periods, affect the calculation of future value, FV, in multi-period investments? As the duration increases, the future value, FV, of an investment also increases, assuming a constant interest rate. How can the time value of money concept be applied to loan calculations? Time value of money can be used to determine loan payments, future loan values, and the overall cost of borrowing. Explain the significance of knowing the payment amount when dealing with annuities in time value of money calculations. Knowing the payment amount is crucial in annuities as it helps determine the future and present values of regular cash flows. How can the time value of money concept be applied to retirement planning? Time value of money can be applied to retirement planning by calculating the future value of regular contributions and ensuring sufficient savings for retirement. Explain the concept of discounting in time value of money calculations. Discounting refers to the process of determining the present value of future cash flows by applying an appropriate interest rate. How can understanding the time value of money concept help individuals in making long-term investment decisions? Understanding time value of money can aid individuals in evaluating the potential returns and risks of long-term investments. Explain the difference between a single-period investment and an ordinary annuity. A single-period investment takes place over one period, while an ordinary annuity involves a series of equal cash flows received or paid at regular intervals. How can the concept of time value of money be applied to mortgage calculations? Time value of money can be used in mortgage calculations to determine monthly payments, total interest paid, and the remaining loan balance over time. Explain the concept of compounding in time value of money calculations. Compounding refers to the process of reinvesting earnings or interest to generate additional earnings over time. How does the payment amount affect the future value, FV, and present value, PV, in annuities? A higher payment amount increases the future value, FV, of an annuity and decreases the present value, PV, for the same number of periods and interest rate. How can understanding the time value of money concept help in evaluating the cost of borrowing? Time value of money can help individuals and businesses assess the overall cost of borrowing, considering interest rates and the repayment period. Explain the concept of annuity due and how it differs from an ordinary annuity. An annuity due involves cash flows occurring at the beginning of each period, while an ordinary annuity involves cash flows occurring at the end of each period. How can the concept of time value of money be applied to evaluating investment opportunities? Time value of money helps assess the profitability and risks of investment opportunities by considering the timing and magnitude of cash flows. Explain the concept of perpetuity and its significance in time value of money calculations. A perpetuity is an infinite series of equal cash flows received or paid at regular intervals, and it has particular importance in valuation and finance. What are the 5 components of time value of money, TVM? The 5 components of time value of money, TVM, are discount rate, duration, payment, present value, and future value. What is the key difference between simple interest and compound interest? The key difference between simple interest and compound interest lies in how interest is calculated. Simple interest is based solely on the principal amount, while compound interest takes into account the balance in the account, including interest earned in previous periods. When is it appropriate to use simple interest in financial calculations? Simple interest is appropriate when interest is only paid on the original principal amount and not on any interest previously earned. This is commonly used in situations where interest is accrued on loans or deposits with straightforward interest terms. In compound interest, what does interest compounding mean? In compound interest, interest compounding refers to the process of interest being paid on the total amount in the account, which may include interest earned in previous periods. As a result, the interest earned in one period becomes part of the principal for the next period, which investment method results in a linear increase in the account balance over time. The investment method that results in a linear increase in the account balance over time is simple interest. What type of interest is commonly used in banking and other financial institutions? Compound interest is commonly used in banking and other financial institutions because it allows for exponential growth in the account balance. Define the term principal in the context of financial investments. The principal refers to the initial amount of money that is invested or loaned. It is the basis on which interest and returns are calculated in financial investments. How does the frequency of interest compounding affect the growth of an investment? The more frequent the interest compounding, the faster the investment will grow over time, as interest is being calculated and added to the balance more frequently. Explain the concept of multi-period investments. Multi-period investments are investments that span over more than one period, usually several years. They can be subject to either simple interest or compound interest, depending on how interest is calculated. When is compound interest more advantageous than simple interest? Compound interest is more advantageous than simple interest when the interest earned in one period is allowed to accumulate and be included in subsequent interest calculations. This leads to exponential growth in the account balance. Which type of interest, simple or compound, results in a higher total interest earned over a longer investment period? Compound interest results in a higher total interest earned over a longer investment period, as the interest earned in each period is added to the principal and contributes to subsequent interest calculations. What are the key terms accrue and principal used for in finance? In finance, accrue means to add or grow, often referring to the accumulation of interest on an investment. Principal refers to the initial amount invested or loaned, on which interest and returns are based. How does compound interest differ from simple interest in terms of interest payments? In compound interest, interest is paid on the total account balance, including interest earned in previous periods. In simple interest, interest is only paid on the original principal amount. Which type of interest is more commonly used in long-term investments and savings accounts? Compound interest is more commonly used in long-term investments and savings accounts due to its compounding nature, resulting in higher returns over time. What is the significance of the duration of an investment in TVM calculations? The duration of an investment in time value of money, TVM, calculations represents the length of time the investment will be held. It is a critical factor that affects the future value and the overall return on the investment. How does compound interest lead to exponential growth in an investment? Compound interest leads to exponential growth in an investment because interest is continually calculated and added to the principal, resulting in higher interest earnings in each subsequent period. When might simple interest be preferable over compound interest in certain financial scenarios? Simple interest might be preferable over compound interest in scenarios where the interest terms are straightforward, and the interest is calculated based solely on the initial principal. Amount. What is the role of the discount rate in TVM calculations? The discount rate in TVM calculations represents the rate used to determine the present value of future cash flows. It helps in assessing the current worth of future cash flows based on the time value of money. In what situations would knowing both simple and compound interest be beneficial? Knowing both simple and compound interest would be beneficial when comparing different investment options or when dealing with various financial products that employ different interest calculation methods. Describe the difference in the growth pattern of an investment under simple interest versus compound interest. Under simple interest, the growth pattern of an investment is linear, with a constant increase in the account balance. In contrast, compound interest results in exponential growth, with the account balance growing at an accelerating rate over time. What does the payment component represent in TVM calculations? The payment component in TVM calculations refers to regular cash flows, such as loan payments or annuities, made at fixed intervals over a specified duration. When is compound interest used in situations involving investments or loans? Compound interest is used when interest is paid on the total account balance, including interest accrued from previous periods. It is commonly employed in long-term investments and loans. How does compound interest benefit savers or investors in the long run? Compound interest benefits savers or investors in the long run by allowing their money to grow exponentially over time, leading to higher returns compared to simple interest. Explain the significance of the future value in TVM calculations. The future value in TVM calculations represents the value of an investment or cash flow at a specific point in the future, accounting for the effects of interest or returns. How does the time period T impact the future value of an investment in compound interest? The time period T has a significant impact on the future value of an investment in compound interest. As the time period increases, the account balance grows exponentially due to the compounding effect. Define the term multi-period investment in your own words. A multi-period investment is an investment that spans over more than one period, usually involving multiple years. It can accumulate interest through simple or compound interest methods. In the context of compound interest, how frequently is the interest typically compounded in various financial products? The frequency of interest compounding varies among financial products, with common options being annually, semi-annually, quarterly, monthly, and even daily. How does the choice between simple and compound interest affect the total interest earned on an investment? The choice between simple and compound interest significantly affects the total interest earned on an investment. Compound interest generally leads to higher returns over time due to the compounding effect. When is it appropriate to use compound interest for calculating the future value of an investment? Compound interest is appropriate when interest is calculated based on the total account balance, including interest earned from previous periods. This method is commonly used for long-term investments. In a multi-period investment, what happens to the interest earned in each period under compound interest? In a multi-period investment with compound interest, the interest earned in each period is added to the principal, becoming part of the new balance used to calculate interest for the subsequent periods. How does the choice between simple and compound interest impact the growth of an investment over time? The choice between simple and compound interest significantly impacts the growth of an investment. Compound interest leads to exponential growth, while simple interest results in linear growth. How can an investor use the concept of time value of money to evaluate potential investment opportunities? An investor can use the concept of time value of money to calculate the present value and future value of potential investment opportunities, helping them make informed decisions based on the potential returns. What is the role of the present value in TVM calculations? The present value in TVM calculations represents the current worth of future cash flows, taking into account the time value of money and the discount rate. How does the interest rate I affect the future value of an investment in compound interest? The interest rate I has a direct impact on the future value of an investment in compound interest. A higher interest rate will lead to a faster growth rate and a higher future value, while a lower interest rate will result in slower growth. Describe an example scenario where simple interest would be the preferred method for interest calculation. Simple interest would be preferred for short-term loans or investments with straightforward interest terms, where interest is only paid on the original principal amount. What role does the duration of an investment play in determining the interest earned under compound interest? The duration of an investment in compound interest affects the number of compounding periods, which in turn impacts the total interest earned over time. Compare the growth pattern of an investment under simple interest to that under compound interest. Under simple interest, the growth pattern is linear, with the account balance increasing at a constant rate. In contrast, under compound interest, the growth is exponential, with the account balance increasing at an accelerating rate. How does the payment component influence the calculation of future value in TVM? The payment component affects the future value in TVM calculations by considering regular cash flows, deposits, or loan payments that occur at fixed intervals over the investment's duration. Explain the concept of interest compounding and its impact on the future value of an investment. Interest compounding refers to the process where interest is added to the principal and becomes part of the new balance for the next interest calculation. This leads to exponential growth in the future value of the investment. What are the key advantages of compound interest over simple interest in terms of long-term investments? The key advantages of compound interest over simple interest for long-term investments are the potential for higher returns and exponential growth, which can significantly increase the final account balance. How does the choice between simple and compound interest affect the total interest paid on a loan? The choice between simple and compound interest significantly affects the total interest paid on a loan. Compound interest usually results in higher interest payments over the loan term compared to simple interest. Explain the relationship between the duration of an investment and the frequency of interest compounding. The duration of an investment and the frequency of interest compounding are inversely related. Longer investment durations allow for more compounding periods, resulting in higher interest earnings. How does understanding TVM help graduates make better financial decisions? Understanding TVM helps graduates make better financial decisions by enabling them to calculate the present and future value of money, allowing for informed choices in investments, loans, and savings. Describe an example scenario where compound interest would be the preferred method for interest calculation. Compound interest would be the preferred method for long-term investments or savings accounts, where the growth of the investment over time is a crucial factor. How does the discount rate impact the present value of future cash flows? The discount rate impacts the present value of future cash flows by adjusting the future cash flows to their equivalent value in today's dollars, considering the time value of money. In the context of TVM, why is compound interest considered more beneficial for long-term savings? Compound interest is considered more beneficial for long-term savings because it allows for exponential growth, leading to higher returns over an extended period compared to simple interest. How does the interest rate impact the growth potential of an investment in simple interest? The interest rate directly affects the growth potential of an investment in simple interest. A higher interest rate will lead to faster growth, while a lower interest rate will result in slower growth. Why do long-term investors prefer compound interest over simple interest? Long-term investors prefer compound interest over simple interest due to the potential for higher returns and the ability to grow their investments exponentially over time. How does the duration of an investment impact the total interest earned under simple interest? The duration of an investment impacts the total interest earned under simple interest by directly multiplying the interest rate by the time period and the principal. What are some practical examples where understanding TVM would be valuable for individuals? Understanding TVM would be valuable for individuals in scenarios such as choosing between different investment opportunities, comparing loan options, or determining the future value of savings. How can an individual leverage the concept of TVM to evaluate the potential profitability of an investment? An individual can use TVM to calculate the future value of an investment, helping them assess the potential profitability and make informed decisions regarding investments. How does the interest rate influence the growth of an investment in compound interest? The interest rate directly influences the growth of an investment in compound interest. A higher interest rate leads to faster growth, while a lower interest rate results in slower growth. In the context of investments, how can TVM calculations help individuals assess risk? TVM calculations can help individuals assess risk by determining the present value of potential future cash flows, allowing for risk-adjusted evaluations of investment opportunities. How does the payment component impact the calculation of the future value in TVM? The payment component affects the future value in TVM calculations by considering the regular cash flows made at fixed intervals, which contribute to the growth of the investment. Describe a situation where compound interest might be less advantageous than simple interest. Compound interest might be less advantageous than simple interest in short-term investments or loans with high interest rates, where the compounding effect may lead to a substantial balance increase. Describe a scenario where understanding TVM would be beneficial for a recent graduate making financial decisions. Understanding TVM would be beneficial for a recent graduate when choosing between different loan options with varying interest rates and payment frequencies. What is the primary advantage of using the compound interest formula for investments? The primary advantage of using the compound interest formula for investments is the ability to assess the exponential growth potential and the higher returns over time. How does understanding TVM impact financial planning for individuals and businesses? Understanding TVM allows for more informed financial planning by evaluating the future value and present value of cash flows, helping individuals and businesses make better financial decisions.